The debt ceiling is a limit on how much the U.S. government can borrow to pay for its expenses. Congress has the power to set this limit, which is currently $31.4 trillion. The government borrows money to cover the difference between what it spends and what it collects in taxes. This difference is called the deficit, and it adds up over time to form the national debt. The debt ceiling is not a new concept. It was first introduced by Congress during World War I to give the Treasury Department more flexibility to borrow money without needing separate approval for each bond issue. Since then, Congress has raised the debt ceiling 78 times, usually without much controversy. However, in recent years, the debt ceiling has become a source of political conflict and economic uncertainty. Some lawmakers have used the debt ceiling as a leverage point to demand spending cuts or policy changes from the other party or the president. This creates a risk of a default, which means the government would not be able to pay its bills on time. A default would have serious consequences for the U.S. economy and the global financial system. It could trigger a sharp drop in confidence in the U.S. dollar, which is the world's reserve currency and a key asset for investors. It could also cause interest rates to spike, making it more expensive for the government, businesses and consumers to borrow money. Moreover, it could disrupt essential payments to millions of Americans, such as Social Security benefits, military salaries and tax refunds. To avoid a default, Congress needs to raise the debt ceiling before the Treasury Department runs out of cash and extraordinary measures to keep paying its obligations. The Treasury Secretary Janet Yellen has warned that these measures may only last until early June. Therefore, it is urgent that Congress act soon to lift or suspend the debt ceiling and ensure that the U.S. government can continue to operate normally and honor its commitments. The debt ceiling is a legal limit on how much the federal government can borrow to pay its bills. If Congress does not raise or suspend the debt ceiling by June 2023, the Treasury will run out of cash and the U.S. will risk defaulting on its obligations. This could have serious consequences for the stock market, especially for the Dow Jones Industrial Average and the Nasdaq Composite Index. The Dow Jones Industrial Average, or simply the Dow, is a stock market index that tracks 30 large U.S. companies from different sectors of the economy. The Nasdaq Composite Index, or simply the Nasdaq, is another stock market index that tracks more than 3,000 companies, mostly from the technology and innovation sectors. Both indexes are widely used as indicators of the overall performance and health of the U.S. stock market. A default on the U.S. debt could trigger a sell-off in the stock market, as investors would lose confidence in the government's ability to repay its creditors and honor its commitments. This would lower the demand and price of U.S. Treasury bonds, which are considered one of the safest and most liquid assets in the world. As a result, interest rates would rise, making borrowing more expensive for businesses and consumers. This would reduce spending and investment, and slow down economic growth. The impact of a default on the stock market could vary depending on the sector and industry of each company. Some sectors could be more vulnerable than others to higher interest rates, lower consumer confidence, and reduced government spending. For example, companies in the financial sector could face liquidity problems and credit losses if their customers default on their loans or deposits. Companies in the defense sector could face lower revenues and profits if the government cuts its military spending. Companies in the healthcare sector could face uncertainty and volatility if the government delays or reduces its payments to Medicare and Medicaid providers. The Dow and the Nasdaq could also react differently to a default scenario, depending on their composition and exposure to different factors. The Dow could be more sensitive to changes in interest rates, as it includes more companies that rely on debt financing, such as Boeing, Caterpillar, and Goldman Sachs. The Nasdaq could be more sensitive to changes in consumer sentiment and innovation, as it includes more companies that depend on discretionary spending and technological advancement, such as Amazon, Apple, and Tesla. In summary, a default on the U.S. debt could have negative impacts on the stock market, especially on the Dow Jones Industrial Average and the Nasdaq Composite Index. The magnitude and duration of these impacts would depend on how quickly and effectively Congress resolves the debt ceiling crisis, and how investors perceive the credibility and stability of the U.S. government.